Welcome into the Crystal Creek Homes podcast. As always, I am your host, Jason Thomsen. Today, we are joined only by Koby Contenti. We are unfortunately not able to be joined by Justin today. He has a conflict that's keeping him away from today's recording time. But today's topic is pretty well suited for Koby to be the expert on here anyway. So we're going to dig into it. Now, Koby, we'll have you introduce yourself, and then we'll introduce the topic for today, and we'll start talking about it.
Sounds great. Thanks, Jason. So my name is Koby Contenti, and I'm a dealing representative with Rethink and Diversify Securities. They're what's called an exempt market dealer that offers a bit of a suite of private investment products that everyday Canadians can look to take advantage of.
Yeah, sounds great. And it is the Crystal Creek Homes podcast, so we always have a focus on Crystal Creek. But as you mentioned, Koby, there are other opportunities available in the space. And what we're going to be talking about today is relevant to kind of everything that you represent, including opportunities that maybe aren't even on Rethink and Diversify shelf, other private investment opportunities out there. What we're going to be talking about today is the importance of investor alignment when you look at private investment opportunities. And we're going to have a focus on the Crystal Creek opportunities today. We're going to use them as examples, dig into it a little bit that way. But the information that we're going to cover here today is widely applicable. It really does apply to any private investment opportunity, even some public investment opportunities that you might participate in over time. So I think it's going to be a really valuable discussion. We are going to try and keep it to 30 minutes or less here today. But we'll cover some good, important content. So to start off, when we talk about investor alignment, I think let's set the table a little bit because there's a bit of a broader consideration, a broader conversation to be had around how to look at investments, private investments in particular, as an investor when you're starting to make an investment decision. Now, Koby, you work with investors every day, helping them to kind of navigate this process. And the very first aspect that people generally will start with and look at is the risk reward profile of an investment. You look at projected returns, you look at projected cash flows, you set your time horizon, figure out kind of how long am I willing to tie my money up in this opportunity, and then what is the risk of the investment opportunity based on the investment itself, the asset class that it's in, the business model that's being executed, the management team behind it, the structure of the investment, all the features, everything. There's a lot that goes into this. But when you're looking at it from an investor-focused standpoint, trying to figure out whether an investment is well aligned with an investor's goals, there's kind of a few different things that we can look at. So we're going to dig into all that. Let's start with risk reward. So Koby, when you're talking with your investors and they're considering different investment opportunities, the risk reward profile in general is a pretty important aspect for most investors when they're approaching this. They're looking to understand the rate of return. They're looking to understand the likelihood of success and the likelihood of failure. How do you kind of walk investors through that initial assessment?
Yeah. So going back to your first point, I think to me, what investor alignment really means is aligning the investor's goals with that of the management team or with the investment itself. And so in the case of Crystal Creek, I think a lot of what goes into risk reward is going to be a little bit of diversification, but also what you as an investor are looking for. If I'm an investor and I'm looking for something that, I can put my RSPs away, I'm going to save for retirement. I'm not necessarily going to be looking for an investment that has a greater potential for downside, or say it's only in one specific project that may be, subject to some factors outside of diversification. But yeah, when I'm talking to clients about risk and reward, it's really what their goals are and finding an investment that suits best for them. If I am that investor looking for longer term RSPs, investment opportunities, I'm not looking for that one, get my money in and out within 3 years. I'm looking for the one that's going to consistently prove over time that it's able to generate returns. And so I think looking at track record too can definitely be a bit of a signal to how an investment is going to perform. But of course, things do happen. But yeah, does that kind of answer your question? Is that a good starting point?
Yeah, I think that's a great place to start. So there's kind of two parts to it, right? There's the risk side and there's the reward side. With Crystal Creek, we have, as you mentioned, a track record of success. Crystal Creek's been operating for 20 years. They've been working with investors for almost all of that duration. And when we look at the track record of success from Crystal Creek, there is a history of making payments. They've never missed an owed distribution, which is a tremendous record to maintain through a 20-year history. All of the distributions have been paid out in full and on time, which is an awesome achievement for sure. And then the performance side has been strong as well. Now there has been variance in performance from project to project. There's some that have significantly outperformed the average. There's some that have underperformed the average, but they've all been profitable at the end of the day. Every project has made investors money that they participated in. So that's another really telling feature. It speaks to both the potential reward, but also some of the risk mitigation side of it. If you have that track record of consistent long-term performance, you can feel better about the risk profile knowing that the management team has a track record of success.
Yeah,
And as you
absolutely.
mentioned, the management team and their experience, that's a huge part of it.
Definitely.
Yeah. And then when you look at that past performance, you can also then see the variance in the reward side, right? When we look at Crystal Creek's average, their average project return is right around 14%. That's a really, really strong double-digit return. It's been through a multitude of economic cycles that they've been able to achieve that. They've seen really strong markets, they've seen challenging markets, and they've been able to maintain returns through the ups and downs. So that's a big piece of it as well. Looking at performance through different economics situations, that's definitely a key element to it as well. And some of that also has to go back to the sector, the asset class that you're participating in. We know real estate is cyclical, so there are good times and there are difficult times. Having a management team that's been able to perform through both parts of that cycle within the asset class that we're considering is a key consideration for sure.
Definitely. And I think another point that we can touch on too, Jason, is going to be if I'm an investor and when I'm actually looking at an investment, trying to base my investment decision off of it, what are kind of the factors that are going to go into considering whether this management team or this investment does align with my goals? So some things that come to mind immediately for me would be, what's the management fee on the investment? What is the issuer themselves or the investment themselves actually taking away, or what's on the table necessarily? And so immediately I think to the mutual fund trust, with Crystal Creek's one specifically, Crystal Creek actually doesn't take a management fee with that investment, which is a very unique. It's not necessarily the standard for a lot of these private investment products. However, it is unique, mainly being that Crystal Creek doesn't need the management fee because, as their mutual fund trust grows, they're able to take on additional opportunities and Crystal Creek kind of benefits on the back end there. But for you as an investor to look at a fund and say, hey, they're not taking any management fees, there's no stipend, there's not necessarily a hurdle rate where, we need to get over X amount before we get our distribution. Those are some things that I think should be on the lookout for investors when reviewing these
Yeah.
opportunities.
Yeah, absolutely. And let's dig into it a little bit. So I think sometimes the best way to learn a process or a topic like this is through some examples, some case studies. Crystal Creek has a few easy ones available to us. So as you mentioned, let's start with the mutual fund trust. Let's talk about the structure. Let's talk about the anticipated return, the risk profile, the history, all that sort of stuff. So looking at the mutual fund trust in particular to start, there isn't a defined preferred return in the offering memorandum. There is a set distribution amount, which is currently set at 9%. Now, that is set at the discretion of management, but we know from Crystal Creek's history and looking at how Justin has run the company over the last 20 years, when he sets a rate, it's because he anticipates being able to maintain it. So we've got that distribution set at 9%. Now, as you mentioned, there is no management fee. So he's not taking money off the top of the returns, putting it in his pocket as a fee for managing the investment itself. As you also mentioned, he sees this as an opportunity to grow his home building business. Now, he does make money off the sale of the homes that they build. So the opportunity for the mutual fund trust to provide more capital that allows them to grow the business and build more homes on an annual basis, that's a reward in and of itself. So that's the reason why he can decline taking that management fee, not taking that off the top, which of course leaves more for the investors at the end of the day. If the pool of investments that we have inside that mutual fund trust maintains that 14% average that we've seen historically, it means all of that capital is going straight to the investor return. And that's one of those alignment features that is just so, so strong. And in addition to that, we also have the funding agreement that's in place with Crystal Creek. Do you want to walk us through what that funding agreement means to investors at the end of the day?
Absolutely. So I'll outline what the funding agreement is. So beginning of last year, Crystal Creek entered what's called a funding agreement between Crystal Creek Homes Inc. and their mutual fund trust. They're two separate entities. Crystal Creek Homes Inc. is kind of the manager of the fund. And so they entered a funding agreement where they are covering all expenses related to the fund, whether that be accounting, legal, anything like that. This is not inclusive of commissions. So commissions are kind of the one thing that the mutual fund trust is still paying for. But that's going to be in place until the mutual fund trust investors receive a 10% annualized return. And so what does that mean for investors? That means that virtually Crystal Creek is covering all of the expenses of this fund until you achieve a targeted 10% return. And so I think as an investor coming into an opportunity like that, it's very comforting to know that, they are putting your interests as an investor first. They are ensuring that, we're not profiting off of your guys' lost gains or non-existent
Yeah.
gains. It's really showing their commitment to the investors. And so I think that's very important.
Yeah, and it's such a strong example of investor alignment to the point where I've actually never seen it in the industry. I've been working in the private capital markets since 2008. So that's what, 17 years now that I've been in this space, and I've never seen a fund manager put a mechanism like this in place where they have agreed to absorb all those initial expenses. The typical model or the typical profile for a new fund is that those upfront expenses, the initial structuring fees, the ongoing accounting fees and legal fees, the administrative burden of the fund is all borne by the fund. And so early investors are often buying into a fund that is going down in value rather than up in value because those administrative expenses represent such a large portion of the overall assets under management that even if the investments that are being made are successful, it's not always enough to offset the costs of a young fund with a small amount of capital in it through that growth stage.
And
Now,
that's
Justin putting this agreement in place, it really removes that exposure, which is such a strong element of investor alignment, where he's not putting that on the backs of the investors. As you mentioned, they're getting the benefit of the investments without the drag of the administrative burden that the fund itself has. So that really is unique. Sorry, you were going to say something there. I'll let you go.
Yeah, I was going to say perhaps this is a way to kind of set the standard going forward. Because if I'm a new fund and, a lot of the mutual funds or exempt market products that you see in this space did start with that similar story where they had that J curve, which is quite standard for all of these funds, where they do lose the value of their units just because, if I have $200,000 in legal fees and my fund's only worth or, has $1 million in cash, that's 20% of my fund. That's quite significant. Whereas if, that fund had 4 million, those $200,000 in fees are going to stay the same, right? And so this is kind of a way to accelerate that process. And we're just starting to see it this first quarter as NAV approaches a dollar and I believe has gone above a dollar. And so that's also super exciting for investors. But yeah, it's definitely accelerated the process, which, I'm invested and as an investor, it definitely brings some comfort for sure.
Yeah, absolutely. It is truly unique. I don't know if it's going to catch on. I hope it does because I think it really is to the investor's benefit. But again, it also requires a certain situation in order for that to even be possible.
Definitely.
Justin has the benefit of having a very successful home building company that he's able to lean on to support that early fund expense. Not all issuers have that benefit or that luxury to be able to absorb those expenses themselves. I do think in situations where it's possible, it is just such a strong differentiator and a really strong advantage for the investors that are participating in this fund as compared to early investors in most other structures. So yeah, super unique, really compelling, and I think a really important feature for sure. Now, That's the mutual fund trust. Obviously, we have diversification. We have a bit of a track record. We've seen NAV growth now over the last year, and projecting that forward, we're anticipating strong double-digit returns out of this fund inside a diversified portfolio that's funding a variety of different projects where new homes are being built, and there's a little bit of existing multifamily real estate in there as well as a bit of a cornerstone for the fund. So it's well diversified. It has a risk profile that I think makes a lot of sense. We've talked in previous episodes about the difference between home building and development. Uh, you can go all the way back. I think that was episode one of the podcast. If you wanted to go back and revisit that topic, talking about the different risk profiles that exist there and the predictability of home building as a business, we've touched on in numerous episodes along the way. So I think if you have a good grasp on the asset class, the business model, the management team, and then you look at a structure like this, it really does offer a lot of comfort and confidence to investors. Obviously, there are no guarantees in anything, but when you can invest with a management team that's proven to have a successful track record and a structure that really does put investors first, I think it can provide a lot of comfort.
Definitely.
And so let's move to a couple other examples. Even under the Crystal Creek umbrella, there's two other investment structures available. Now, they're only available to accredited investors, so this isn't necessarily widely applicable to everyone in the audience, but I still think they're good examples of structural ways that you can, again, put investors first and make sure that that alignment is there and strong. So we talked about the mutual fund trust. Let's talk about the limited partnerships themselves as a structure because accredited investors do have the opportunity to invest directly into single limited partnership opportunities where you're choosing one community, one specific plot of land, and the number of homes that are going to be built on that piece of property. It's a shorter term investment. Typically, these are 3-year projects, 2.5 to 3.5 years kind of thing. So there's a little bit shorter window, but again, no real diversification. You're in one project. And the structure of this also provides really strong investor alignment, but in a different way than the mutual fund trust. So let's talk about preferred returns, how those work, and then the profit sharing mechanism that's in place once that preferred return is achieved. So Koby, why don't you walk us through an example of one of the LP offerings that's available at Crystal Creek right now and how the structure currently sits?
Absolutely. So let's walk through Tazal Park. It's a new one, their newest
Yeah.
one actually. So it's a development here in Calgary in the southwest. It's actually on Tsuut'ina Nation land. So it's on the corner of Tsuut'ina Nation or Tsuut'ina Trail, sorry, and Glenmore Trail. So very unique piece of land, very unique opportunity to Calgary. And so Crystal Creek, when they're entering that community, they've entered the home saying, or sorry, entered the community saying, we're going to take these two parcels of land. It's going to be 92 units total. We're going to build and sell those homes. And the way we're going to do that is we're going to set up a limited partnership that's going to hold all of the land, all of the construction, all of the financing in that limited partnership. And then we're going to go and seek outside investors to assist us in, securing capital to assist us in building these homes. And so what that looks like, they offer an equity position. And so that equity position, there's different classes of units. The differentiation between the different classes is just the unit price, which tends to happen at different timelines throughout the community. But let's just do Class A. It's the cheapest unit price and it's the earliest one that typically happens. So as an investor in Class A, I get however many units at 50 cents a unit, and I'm going to get a preferred return on a quarterly basis. And what that preferred return looks like in Tazal Park is 8%. So that's 8% quarterly, so 2% a quarter. And that's going to happen every quarter until kind of that final home takes possession. And then once the project is complete, we've built and sold all the homes, or Crystal Creek has built and sold all of the homes. They say, great, we've got a portion of 25% of the net profit or losses achieved by this limited partnership to its equity investors. And so me as an investor, if I'm looking for some potential upside, if I'm looking for, maybe an additionally higher risk investment opportunity, but it could come with some of that higher returns potential, that's the route that I'm going to be looking at. And so, yeah, you get a nice preferred return. Towards the end of the project, you get all your capital back. And then there's also a stipend for some profit sharing.
Yeah, yeah. I think that structure is a very consistent, frequently used one. I think this is one that if you're a regular investor in private investment opportunities, this is something that you would have seen right across the market. It's something that's pretty widely used, but that preferred return sets the initial, not the floor, because a property or a project could underperform that preferred return, but it sets the threshold that the manager has to achieve before they can start to make money off the project. So in this case, the Taza Park project has an 8% preferred return. The project has to generate 8% a year to investors before there's any profit sharing going to the management team. So that first 8% really is going to investors first. That's the alignment that we're talking about. When the first money earned goes to investors, it really does create strong alignment where investors' interests are prioritized, they're put ahead of the management team. And then the profit share over and above that, the split that's there makes sense. The remaining profit is split 75-25 in this case, 75% to the management team, where they can recoup some of that profit that they've already generated and paid out with the 8% preferred return. But the investors still participate in the upside as well. And with this structure, there's no limit on your overall final return. Like if the project made 10,000% returns, you would get 25% of that. And so your annualized return would be astronomical in a situation like that. Now, that's not a reasonable or realistic projection by any means, but there is no upper limit on the return in a profile like this. And that's the important risk return or risk reward element to it. As you mentioned, if you're willing to take a little bit more risk, a little more uncertainty, and you're willing to open yourself up to a variety of returns, because if a limited partnership does perform poorly and it doesn't achieve the 8% priority return, the investors only receive the profits that are generated. So if the total project, there are delays, there are issues, there's sales pace problems, there's additional expenses that are incurred, the total project only makes 6% on an annualized basis. That's all the investor makes at that point. So there is more variability to potential returns. Whereas on the flip side, if the project does really, really well, the sales pace is strong, the units are sold on a faster timeline than what we anticipated, then we've seen returns on some of these projects up in the 30% range on an annualized return rate. So there is some upside there, but it does come with a bit of a trade-off. There's that downside risk, that variability risk that you are taking on for the potential of a higher return should the project really perform well. So again, I love that structure. I love the alignment that's there. I love that the investors participate in all of the upside when the project does really well. We've seen investors really make out well in these projects. But again, it does have that downside caveat of just a little bit more variability and the potential for lower returns as well if the project doesn't perform as well.
Definitely.
So that's the great second option. There is a third option that's almost the exact mirror image of that. So instead of taking on that additional variability, the third option with Crystal Creek removes all variability. And it really is a very predictable, consistent, cash flow oriented opportunity to participate with Crystal Creek. Do you want to introduce this one and tell us a little bit about the features of the third option with Crystal Creek, which is again
Absolutely.
only available to accredited investors?
You bet. Thanks, Jason. So on the flip side, the limited partnership on the one side offers the equity participation, and then it also offers a debt instrument via promissory notes. So these promissory notes are directly to the limited partnership, and they're actually corporately guaranteed by Crystal Creek Homes Inc. And so they are 12% promissory notes that pay interest payments monthly. So as an investor, you don't have any opportunity in any upside, but also there is potential for your downside to be covered. Should the project not achieve that 12%, well, Crystal Creek Homes Inc. is a separate entity and they have corporately guaranteed your investment. Now, of course, the question then becomes, well, what happens if something happens to Crystal Creek? There are still risks involved with these investments. However, on a project-to-project basis, it does take out some of that variability and provide a little bit of consistency as well.
Yeah, yeah. And I think when you look at something like a corporate guarantee, like we don't use the word guarantee in this space very often because it's almost anathema for private investments to say that there's any kind of guarantee in these investments. But in this structure, it is guaranteed by Crystal Creek Inc. So As long as Crystal Creek Homes continues to exist and thrive, this is a debt obligation that the corporation is taking on, saying, regardless of the performance of this individual LP, the parent company is going to make these interest payments and return the capital at the end of the term. So if the company at large continues to succeed, we have a 20-year track record, 20-year history saying that they've been a successful company to date. We know that on average, the projects have returned about a 14% return. So if that continues and everything continues to occur in the way that it has in the past, even if one project really does underperform, this takes out that variability. As long as Crystal Creek is still there to pay the bill at the end of the day, the investors receive their 12%. They receive it on a monthly payment schedule, so it's really consistent. It's great for income-oriented investors. Again, it's only available to accredited investors, and it's not eligible for registered accounts. So it has to be a cash investment. But if you're in retirement or approaching retirement, you're looking to secure that income stream inside your portfolio, an investment like this is such a compelling option because there really is a significantly reduced risk profile, knowing that Crystal Creek Homes stands between you and a potential loss. And that predictability of income is backed by a large, reputable, successful company. And having that risk profile for me makes me feel very confident. And the rate of return is very, very strong for something with a risk profile like this. Like most income-oriented investments with any kind of security in them offer return rates that are significantly lower than that. Crystal Creek obviously knows that they're able to generate a consistent profit on these projects. All they're really caring about at the end of the day is raising the capital. So if they offer a structure that makes sense for some investors that are looking for this income, looking for that assurance, this is a really unique and valuable proposition. Again, if you're an accredited investor, you're able to invest cash, this could be a really nice fit for you.
I quite like having three different streams. If someone comes to me and they say, "Oh, I've seen Crystal Creek, I'd love to learn more about that one specific opportunity."
Yeah.
Then the question becomes, well, what are you looking for? Because they have so many different types of offerings and different fits for different investors. If I'm, like you mentioned, an income-oriented investor, maybe I'm looking for a promissory note if I can qualify as an accredited investor. Or if I am that retiree that I mentioned earlier and I'm just looking to save for retirement, I don't want to have to touch it or worry about, what happens in 3 years when the project returns. They've got the mutual fund trust. And so there's fantastic opportunities. There's a variety, which is always great to showcase to investors. And yeah, it's all super exciting stuff.
Yeah, yeah. And there's also some additional ancillary benefits in some of these structures, like the limited partnership offerings, for example, offer some nice tax advantages. There's some flow-through benefits during the first year or two of a new limited partnership, where some of those expenses of the partnership can be flowed through to the unit holders, and give them a bit of a tax write-off that they can use against other taxable income. In the mutual fund trust, if you invest in that outside of a registered vehicle, there's similar benefits. The distributions are return of capital, so those cash distributions aren't taxable. You're not necessarily getting a write-off, but you're getting very efficient tax deferred cash flow that turns into capital gains at the end when you exit. But we know capital gains are more efficient than income, so it still provides some tax advantages. There's lots of good benefits that can be built in structurally that give investors benefit at the end of the day. And that's really what we're looking for when you're talking to an investor and trying to figure out where the best fit is for their capital. It all comes down to their individual situation, their individual goals. So it's important for them to be able to sit with someone like you, a registered representative that can walk them through their options and really help them figure out which one is best for their situation. Uh, and it works so well to have these three different options available through Crystal Creek. You can look for similar features with other investments as well. If you have an income-oriented opportunity, look at the predictability of that income, look at what's driving it, understand where the investment generates the income to be able to pay that distribution to you as an investor, and understand if there are covenants in place that assure that income stream. That just offers a higher level of investor alignment, which is what we're talking about here today. If you're looking at a more equity-based structure, look at that that preferred return, look at the profit share, make sure that those total returns line up with your expectation given the risk you're taking on in the individual investment opportunity. And if you're looking at something in your registered accounts, you can do the same type of analysis. Look at the cash flow that's generated, look at the growth that can be achieved, look at the projections for return, the timeline, and figure out which opportunities fit your profile best. So yeah, I'll pass it over to you, Koby, for any final thoughts that you might have, and then I think we're pretty much at the end of this topic. We'll wrap it up.
Went by quick. Yeah, I think kind of closing notes would be as an investor, look at how the company operates. Make sure that you're understanding how the fund is investing, how the fund is earning its returns. How are you as an investor going to be rewarded? If I am more of an equity, I'm looking for some potential upside. Am I in it alongside this issuer, or am I, kind of just a bit of a bank account for this issuer to, have access to my capital kind of thing? And so I think ensuring that, you as an investor do your own due diligence, understand where these numbers are coming from, and you can make a more knowledgeable decision moving forward. And yeah, there's
Yeah.
lots of opportunities out there, and I think each of the ones we covered today are all fantastic. So thanks, Jason.
Yeah. And for each opportunity that you consider, look at the offering documents. If it's an offering memorandum offering, then dig through the offering memorandum, look at the structure, have a look at the fees that are being charged, make sure that they're reasonable, do some math, figure out how they add up. Lean on someone like Koby with the expertise and the knowledge to kind of navigate that process with you and give you some feedback and advice based on his experience. That's always a great way to start. And if it's not an offering memorandum offering, dig into the term sheet, look at the other marketing documentation, find out what's going on with it, ask questions. Make sure that you really understand these investments before you choose to allocate your capital towards them. So yeah, thank you so much, Koby. It was a great chat. We missed Justin. We'll see him back next episode. But I think we covered some really good topics here, some really good information. And I hope it was valuable to our viewers. If you found value in this conversation, you want to be notified about future episodes as they're released. Definitely do subscribe to the channel. We will send out new episodes every 2 weeks. And so there's always new topics to discuss and cover. We'll continue to dig into what makes Crystal Creek so special, but also about the industry at large, other investment opportunities and the like. So yeah, definitely subscribe. Thank you so much for taking some time out of your day to join us and watch this, whether it's live or whether it's on the recording. We appreciate you taking some time to learn a little bit more about Crystal Creek. Thank you so much. Have a great week.
Awesome. Thanks so much, Jason.
You bet. Have a good one.